सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So, cut the clutter. Today, we are daring to utter the A word, A for Adani. Now, there are many amongst us who would say, why just A word? Why not an A word, Ambani, Adani? Because you know what used to be Birla Tata in the past, rich people, Birla Tata, anybody who spoke for Indian business, Arey tum Birla Tata ke chamche ho, you are in the pay of Birla Tata. Similarly, today, you are a chamcha of Ambani, Adani, you are in the pay of Ambani, Adani. Because in India, for some reason, we have always tended to be judgmental in a negative way about wealth creators. Now, that said, we also believe that capitalism and capitalists, wealth creators, they are wonderful, but they should function within a well-regulated, fair environment, because the difference between capitalism and crony capitalism is very little. It is one false step or one poor level of regulation. So all those are debates that go on. Within that larger debate, the question that's popped up right now is Adani. So the A which is most prominent is Adani, and not just because of what's happened between his companies or his bid to acquire NDTV. That's a different story. I'm not talking about that. That is something on which a lot has to come out yet. Adanis have to speak. Most importantly, NDTV has to speak more, and the Ambanis and the rest of the markets have to figure that out. So I'm not going there. I am looking at Adani in a completely different context. And that context is set by a report that came out sort of coincidentally, serendipitously. If you are a believer in conspiracy theories, which I am not, then maybe deliberately it was timed like that. But on the day the story of Adani making a bid to acquire NDTV came out, just preceding that, maybe 12 hours before that, a report came out of Fitch. Fitch is an international rating agency. Now I know that rating agencies have not particularly been in good order for the past many years, because if you trusted rating agencies and AAA ratings, etc., then I will tell you to look at what happened to so many of the holdings of Ireland FS, DHFL, Yes Bank, etc., etc., etc. In fact, the rating business draws its own skepticism because of failures like these that I mentioned. But this is not even a rating agency report. Fitch is very careful to say that this is one of our units, like one of our research units, which has produced this report. This research unit is called Credit Sites. Credit Sites, and this report is written by 3 analysts, that is R. Lakshmanan, Rohan Kapoor and Jonathan Tan. What does this report say? This report says that the Adani group is excessively over leveraged. What that means is, leverage means debt, udhar, which means if this is a chair against which I want to borrow, when I want to borrow money, I need to have an asset. So I go to a bank and I say, this chair is worth 3,000 rupees. Please give me a loan against it. The bank may give me a loan of 1,500 rupees. So I have leveraged this chair to take a borrowing of 1,500. But what happens if my chair is worth 3,000 rupees, but I have taken debt of 30,000 rupees? Then it becomes excessive or overly dangerous, because I don't have the asset to pay this back. On the other hand, in entrepreneurship, when an enterprise borrows money, you also borrow on the basis of your business plan, prospects of your business. That my business will grow, and as it grows, produces profits and surpluses, I will pay back my debt. So that is where we understand, that is to understand what debt is. And they say that it looks excessive because Adani Group has taken too much debt. Now, what is too much debt? That is what we need to understand. If you look at this report, as I have seen in detail, it's a 16-page report with lots of tables and things. It takes some reading, particularly for those who are sort of naive in this area, people like me. This is not really in my syllabus. This is not politics. This is not global diplomacy. This is not geostrategic issues. This is not sport, right? This is hard finance and banking and markets. So this is not really my area of expertise, but I'm also fortunate. I have good colleagues who can give me wisdom by reading up. I can read up a little bit and I can research a little bit, and at least I can read some balance sheets. And also I have find people in the world of business, markets, finance who I can call and get some analysis or some ideas from. So based on that, I've done a reading of this report and I'm giving you some insights. So we understand, is Adani Group an asset for India, or is Adani Group now a clear and present danger, maybe too big to fail because they are such a big company, $200 billion market cap into everything, crucial areas, or because they are borrowing so much money, they have put the system at risk, they have put India's banks at risk. What happens if they fail to pay? And anybody, I'm now underlining the fears that are being expressed, that maybe they've borrowed much more than they can repay, that they've swallowed much more than they can chew and digest, and the whole country and the economic system and the banking system may get indigestion. See the front page of the report. If you just see the headline, it looks like the report is suggesting that this is a very risky situation for the Adani Group. What is the Adani Group? I told you $200 billion market cap, and this is about reckoning on 18th of August this year. So from about a week before, I am recording this one. Now, the highlights of this report, I will give you a summary. The highlights are, number one, that the group has very aggressive expansion plans. You don't need dadas at Fitch to tell you that they have an expansive expansion plan. It's also an expensive expansion plan because they are moving into areas of infrastructure, etc., which are capital intensive. Second, they say they're moving into more and more new and unrelated businesses. So what is an unrelated business? And unrelated businesses, again, to give you a very simplistic idea. Suppose there is a real estate developer. If a real estate developer who's now building one tower borrows money and decides to build 10 more towers, or decides to build towers instead of one city, 5 more cities, or maybe 20 more houses or whatever, then it's expansion in the same area, not in an unrelated area. Unrelated business would be if the same real estate developer borrows money and says, oh, now I'm setting up a taxi rental service. Now I'm setting up a restaurant chain. I'm setting up a food delivery service. I'm setting up a multiplex business. I'm starting to make movies. I'm setting up a pharmaceutical factory. These are unrelated businesses. So when you do that, then do you have the management bandwidth to keep an eye on everything? Right? That is a question they raise, and they say that because the group is moving into so many areas, this might lead to systemic risks because nobody can keep an eye on so many diverse things all at the same time. Of course, the answer to that is if we get professional CEOs everywhere and if you empower them to work, unlike, say, the chief ministers of the BJP these days, barring one chief minister, everything else is controlled centrally, or unlike, say, the chief ministers or anybody in the Congress party where everything is controlled centrally. So if you let your CEOs function sort of autonomously with an oversight at the group level, maybe you can run it. But they say that's an area of risk. Third, they say there is little evidence of promoter equity or capital injections into group companies. That as companies are borrowing more money, as I'm borrowing 30,000 rupees against, say, this chair which is worth 3,000 rupees, am I then putting my own money from my own savings or wherever to maybe buy 3 more chairs so that my underlying asset becomes 3 times as much? Now, I know as I explain this, it sounds overly simplistic, but then this explanation is not for the market player or a market dada. This explanation is for those like me who are not in the markets but who want to understand the issue. So they say that they have little evidence of the owners putting more money into their own companies. Now there is a little twist to that, to which I will come. And they say because they are not putting in more of their own money, they are not reducing leverage in their stressed balance sheets. What is that? My balance sheet is stressed when I have borrowed 30,000 against a 3,000 rupee worth of chair. If I bought 2 more chairs with my own money and maybe a sofa and a coffee table, then my balance sheet becomes less leveraged or less stressed because my asset base goes up. Next, they say that they worry that there is a strong competition building up between the two A's. So this is A versus A. Adani versus Ambani. And they say because of this competition, it is likely and possible that imprudent financial decisions may be taken by the Adani group. What do we mean by imprudent financial decisions in a competitive situation between two titans? So I can give no better than give you an example of a very bad such case. And that very bad such case involved two of India's finest airlines. In fact, at that point, two of the world's finest, most admired airlines. That is Jet Airways and Kingfisher, both run by formidable owners, Naresh Goyal and Vijay Mallya. What happened there? Word spread that Vijay Mallya was acquiring Deccan Airways. So if they acquired Deccan Airways, they will get this much more market share. So that then provoked Naresh Goyal of Jet Airways to try and acquire another company. So he went ahead and acquired Sahara. So in that competition, both these owners ended up acquiring broken aviation companies just because they were competing for market share. Both of these turned out to be financial decisions so imprudent that both their fine companies went belly up and both went bankrupt, and we know exactly what happened with them. So that is what happens when two mega egos clash or titans in the corporate world clash. They can make ego-driven, imprudent decisions. Although I must say, on the track record of both A's until now, Adani as well as Ambani, I would say that they are much smarter businessmen than Naresh Goyal or Vijay Mallya. So the chances of this happening, in my view, are not very high. But analysts list these as risk factors. Next, they say there are governance and ESG risks. That is a bit like platitude. That's like saying I'm planting my crop for Rabi or Kharif. There is a risk. If rain doesn't come, what will happen? If too much rain comes, what will happen? That's a bit like that. ESG, by the way, stands for environmental, social and governance. So you know what all that does that mean. So those risks, particularly because the company is into heavy infrastructure sectors, ports, highways, logistics, airports, etc., etc. So those risks are there, but that's a normal thing. Then they say, what is it that's working for the company? And that's very important. And that might please the skeptics also, skeptics or critics of the Adani group, or critics or those who fret over the Ambani-Adani phenomenon, right? They say that the positive is that the company, the Adani group, has solid relationship with banks. That's fine. And you might say that's because of cronyism. But again, there's a fact-based twist there that I'll come to. And also that they are very friendly with Modi government. And that might please critics or cynics or skeptics who say that all of the success of the AA phenomenon, that is Ambani-Adani, is owed to crony capitalism. Now, that is what these analysts also say, but they list this as a positive, that the group has a very friendly relationship with the Modi government. Then they say, among positives, that Adani Group has a strong track record of launching strong and stable companies. So they've launched many companies, they moved into many areas, but these are all strong and stable with good, strong governance. So that is another positive. And then they say in India, there's a lot of emphasis on building infrastructure now, and they are heavily into infrastructure areas, infrastructure, energy, and expanding there. And that's why they are guaranteed, or they can strongly expect a lot of tailwinds or support in that area. That is not cronyism, that is tailwinds for infrastructure building in India. And that's why they say that their overall recommendations are performed. So once again, when you see that front page, it looks like this is not quite the equivalent of this report that Credit Suisse produced several years ago called House of Debt, which pointed out, which quite rightly, that Indian corporates had taken too much debt, there was too much leverage, too little of underlying assets, and a crash was coming, and crash did come. This is not the analysis, and if you weigh the negatives and positives, this does not add up to that kind of a dire picture. So they say overall, we still have a perform recommendation. That means the shares of this group will perform, or the companies of this group will perform. And they say we remain cautiously watchful of growing expansion appetite, which is largely debt funded. So cautiously watchful, that we are keeping an eye, Group is expanding very fast, but with the qualification that most of this growth is funded by debt. The group is borrowing a lot. Is it too much? That is something, that's a question that we are debating right now. Now, as we talk, you will see some charts on my screen. We haven't made these charts. These charts are from the Fitch report, or more accurately from the Credit Sites report, because Credit Sites is a unit. Remember, Fitch has said that they don't put the rating agency's imprimatur on this report. This is one of their research units. If you look at the charts in this report, I'll share some of these with you and give you very brief explanations as to what these mean. So you see the first one. The first one is about G spreads. So what is G spread? Again, this is something that I've learned. It's something new that I've learned. I know if you're in the world of finance, banking, you will laugh at me. कि कितना बेवकूफ आदमी है, इसको इतना भी नहीं पता, he doesn't even know ABC, but that is the ABC of your business, not ABC of my business. So I have to be forgiven. Now, G spread is the spread that a company has to pay on its borrowing. I borrow 100 rupees from you. You will say, I will lend you money. How much interest are you paying me? I'll say, I'm paying you 10% interest. You will say, oh, look, 10%, it looks a bit risky because I don't think you have that much money in your bank and you may be gambling with my money, so it's too risky. So I will charge you 20% interest. What that means is that the more insecure the lender feels about lending to me, the higher the interest rate will be. So who's the safest borrower? The safest borrower is a sovereign. It's a government. And then it also depends on the quality of the government. How good is a government sovereign guarantee? Now, Indian government, for example, has a very solid sovereign guarantee. You know that once Indian government's guarantee is there, your principal will not be lost. It's other sovereigns which might have trouble. Turkey will have trouble. Sri Lanka will have trouble. Pakistan will definitely have trouble, but not India. So at India's sovereign guarantee, Government of India's bonds, at what price are those bonds selling? Which means what is the market willing to buy those bonds at what interest rates? That is your government rate. That is what G stands for. Spread means when a company goes out to sell bonds, how much more interest does the company has to pay beyond this government rate? That is called a G spread. So as we can understand, the higher the G spread, the riskier your bonds. Lower the G spread, the less risky, the safer your bonds. So if you see this on this list, this chart, you will see that Adani Group's bonds are at the higher level. So 375 basis points, which means if your national government securities are selling at 6% yield, 6% interest, Adani Groups will be 9.75% of these companies. That there are other Adani companies which are less. So Adani companies generally range between 250 to 375 basis points. And you can see other companies, BPCL, which is a government company, PSU, 175 basis points, Bharti Airtel, 220 basis points. Then RIL, safer still, sounder still, 175 basis points. And Indian Oil Corporation, 75 basis points. So every company will cost you more than government securities. Every company will be selling, its bonds will be selling at a G spread, G plus something. But in case of Adani, these are higher. So market perception is that the risk with these bonds is a little bit higher. Then you see the second one. This is something, again, something new that I learned. This is called yield to worst. Worst, sabse kharab, yield to worst. Now, what does yield to worst mean? And what kind of a metric is it where lower is better, right? Higher is worse, lower is better. So yield to worst, as I have now understood, talking to some gyanis in the business, is that when a company floats its bonds, it also has the right to call back its bonds. When does a company calls back its bonds? So a company may float bonds, say of 10,000 crores at 6% interest. 5 years from now, the company thinks, look, I'm paying too much interest on my bonds. Today, I'm so strong and the market is so good that I can borrow the same money, say at 4%, right? So at 6%, I'm calling my bonds. I'm giving everybody their principal back and their owed interest back. And I can float fresh bonds at 4%. So yield to worst is the lowest yield at which the company will recall its bonds. So that's why lower is better. Higher it is, that means the company's ability to borrow at a lower price is limited. The lower the price at which a company borrows, the sounder its bonds seem. That's why yield to worst, a good yield to worst is a good indicator. If you see that, then you will see one Adani company, that is the Adani Green Energy Limited, has quite a high rating there. And as I told you, high is bad, low is good. But once again, it is of the same level as its peer group company, which is the Renew Power, which is again a green energy company. Renew Power, by the way, is run by Sumant Sinha, the son of Yashwant Sinha, the politician. And again, if you see this metric, you will see that JSW, which is a Jindal Group company, steel company, that is a little riskier, and then Jubilant, Tata Steel are then better or sounder. But once again, you don't see anything outlandish in the case of Adani, although they are seen to be more volatile than some of the rest. Then outstanding bonds. If you see outstanding bonds and see what kind of interest is being paid, again you see this chart, you will find that some Adani companies are paying higher rates for their bonds. The highest is for the Adani Green Energy Limited, that is the alternate energy or renewable energy company, 6.25%, but that bond is maturing at 2039. Another bond, which is at 5%, Adani Ports and SEZs, is maturing in 2041. So once again, interest rates are high going by the current standards of international bonds, but the maturity is a long time away. So this is not an immediate risk. Now, when we were talking about the report saying that Adani's ability to invest more money in their own companies is limited, I told you that there is a twist. And the twist is in this chart, again from the report. Again, it's the report, it's data. Data is accurate. You can make this interpretation of it or that interpretation of it or both interpretations of it. If you look at this chart, you will see the key Adani companies and where they are valued, and see the promoter equity in these companies. Promoter equity is the amount of shareholding the owner or the promoter or the founder still has in these companies. So Adani Enterprises, 3,55,000 crores, 3.5 trillion, I will use trillion henceforth. Green Energy, 3.5 trillion market cap. Adani Ports and Special Economic Zones, 1.8 trillion market cap. Adani Power, 1.5 trillion market cap. Adani Total Gas, Total is the French company, 3.8 trillion market cap. Adani Transmission, 4 trillion market cap. Adani Wilmar, which is the FMCG company that makes edible oil, etc., that is 944 billion rupees. All these figures that I quote are in rupees, market caps on Indian stock markets. But see the promoter equity in these companies, and that is the key thing. Adani Enterprises, 74.9%, Adani Green Energy, 61.3%, Adani Special Economic Zones and Ports, 65%, Adani Power, 75%, Adani Transmission, 75%, 74.9%, Adani Wilmar, 44%. Only in Adani Total Gas, it's 37.4%. But there also, I presume that's because Total has a sizable equity also. It's a joint venture. So you can see that Adani's, the family, has a very large amount of equity already in these companies. Now, this has two aspects to it. One aspect is that, look, they have such a lot of skin in the game. How can they let these companies go down the drain? The other is, this also puts in perspective for us the wealth of the Adani family. Now, there is a lot of noise and there is a lot of talk about how rich the Adanis have become. Adani has become the richest man in India, beating Mukesh Ambani, among the richest in the world, I think fourth richest or something, etc., etc. And then this provides grist to the mill, and this provides fantastic headline hunting opportunities to Oxfam, etc., and all other povertarians. 1% people control 500% of a nation's wealth. I mean, I'm exaggerating, they don't say 500%, but I'm exaggerating also to underline the fact that this is such a fake way of calculating. This is paper wealth. This wealth is based on the market cap of the shareholding these people have in their companies. So I can do no better than read out to you a para from this report, Credit Sites report. And that para is that while people might say that Adani is so rich, richest man in the world, why should his companies have a problem? If they have debt issues, he can always give them more money. This report says, and I quote, however, we note that this is paper wealth and largely tied to the value of his holdings in the Adani Group stocks, which have risen significantly in recent years. Right? So what that means is that all this is in his stocks. He owns 75% of a company. If he wants to take out money, he sells even 2%, and word spreads in the market that Adani is selling his own stock price will collapse. And what is seen as today so much market worth will come down accordingly. So this is a completely fake metric to say somebody is the richest, more powerful, controls so much of your wealth, because this is paper wealth. And the funny thing is that the same people who are so skeptical about stock markets and all then make such a big deal of paper wealth just because it suits their argument. Then the analysts point to some risky areas. First of all, they say that a lot of this wealth is built on sudden rise in stock prices. And they point out that in last 3 years, 2.5 years, the pandemic years, Adani stocks have performed at a counterintuitive level, sensationally so. So there was one company that has grown 130% in 2020, 248%. 2020 was the big lockdown year. 248% next year, 49% the next year. Another company, 230% in the lockdown year, 2020, 590% in 21, and so on and so forth. So if you invested 100 rupees in Adani Green Energy in 2020, it's already become 2.5 years, 1200 rupees. So they say that this rise is too much, so we don't know what might happen at the end of the day. Then they say some of the investments have come from opaque funds. These are based in Mauritius, from the same address, and all their assets under management, or AUM, are in the Adani Group companies. So we don't know what exactly these are. Now, what is the counter to this? So again, if we read the balance sheets and we also speak to people in the Adani Group and figure out their own data from their balance sheets and also from the financial press, particularly Business Standard. I think there is a story by Dave Chatterjee, which I'll share with you. Also Bloomberg, I'll share that story also with you. It looks like that while the group has on paper debt of 2.2 trillion rupees, that is 2,20,000 crore rupees. Once you break down that debt, picture changes somewhat, because out of this debt, 20,000 crores is debt against receivables. That's like the working capital account of a company, that I have to get so much money over the next 3 months for the sales I have made. So from the bank, I can draw against that. That is a normal thing in businesses. That is not a long-term liability. Second, about 33 to 35,000 crores of this debt is the promoter debt to their companies. That is the Adani giving their own money to their companies, their own companies, as loans. So while it is still a debt in the company's book, the fact is promoters themselves will not take their companies to the bankruptcy court. Worst coming, it will be converted into equity at some point. Again, the companies, if you look at the balance sheet today, are holding cash and cash equivalent, anything between this floats between say 25 to 30,000 crores. So if you take all of that out, then the net external debt comes down to about 1.38 crores. So if you look at that, and if you then also look at the size of the companies, it does not look that alarming. Yet it's a lot of debt. But there's one more fear, that all this debt must be coming from public sector banks, because Adani and Ambani's are part of this crony capitalism system of the Modi government. So this puts a lot of risk on nationalized banks. The picture, however, is different. If you look at the data once again, the data tells us that in 2016, 55% of all of Adani Group's debt was from PSU banks. Today, it's only 21%. So if their debt from public sector banks is only 21% now, where has the rest of their debt come from? So 50% of their debt right now comes from international bonds, which are rated by the same rating agencies, of which Fitch is also a member. So these facts we need to understand before we jump to any conclusions on this side on that. I'm doing the best I can, which is giving you the full picture with some analysis.